Hello everyone, and welcome to this presentation of the right way to trade tops and bottoms. Welcome and thank you for taking time out of your Wednesday afternoon to join us. My name is Steven Primo. I am the president and founder of Specialist Trading. And for those of you who were not familiar with our website, we are first and foremost an educational company, even though we provide all of our members and students with strategies and with signals and with ways in which to trade all of the markets. We're really about educating you. We're really about putting you in charge of your decision-making process. We feel that too many traders are losing in the marketplace today because they rely on outside sources to make their decisions for them. Either they put too much importance in indicators or some trading room or chat room or some trading guru or some news events, and they're really taking their power away by not making the decisions themselves. And the only way we feel to do this is to empower yourself by good, solid education. Now, I've been trading for 37 years. I started my career on the floor of the Pacific Stock Exchange. I was on the trading floor for a total of 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Gen Rep. So I've seen and traded just about every market imaginable, from the crash of 1987 to the great bull market that ensued after that. I left the floor in the mid-90s to manage money and to trade my own account. I've been the director of education for a number of websites, and roughly about 6 or 7 years ago, I started Specialist Trading, where I just teach and educate my students and members all the things that I personally use myself. So when we speak about being an educational company, I'm really sharing all the things that I've accumulated in my 37 years of trading. Hopefully, we can shorten your learning curve. So if you're having difficulty right now and you just can't seem to make ends meet, don't worry. I know exactly what that's like. I went through that same process myself when I first started trading. And so hopefully we can help you along the way and educate you so that you won't have to be trading 37 years to get on that road to consistency. Excuse me. Now, before we begin, we're required to show you our disclaimer, so I ask that you please take a moment to view it. I'm going to show you a lot of performance results, showing you a way, the correct way, in our opinion, to trade tops and bottoms. But please remember that we can in no way guarantee that any of the results I'm about to show you will be repeated in the future. So please take a moment to view our disclaimer. And while you're doing that, I'd also like to mention that we have a fairly large group today. That's great. I know we have some new people here in attendance. So if you're new to my presentations, you'll see that I like to take questions, but at the very end of the webinar. So I like to have it more like a class where we wait till the question and answer portion of the presentation. So if you happen to have a question, kindly write it down or try to remember it, and I promise we'll get to it at the very last 10 or 15 minutes. This won't be a real long presentation, so don't worry. We'll have plenty of time for questions and answers. If you'd like to speak to someone personally, I'll also leave you with an email address as well as a phone number where you can contact us personally and speak to us over the phone or through email. Okay, so lots of ways to ask questions. I think the most common question I get asked is, will this be recorded? And yes, for those of you who may have to leave early, this will be recorded. You can contact us later at the phone number or the email given under the chat box, I believe, in your right, and we will send you the link to this full recording. But remember, please ask the questions at the very end of today's class. Now, one last thing I'd like to mention before we begin. You can now follow us on Twitter. This is our handle here at Specialist Trading, abbreviated to SPCLST-TRADG. That's our handle at Twitter. And we post a lot of great free information, not the kind of up-to-date information that you'll get if you're a member of Specialist Trading. But recently we had a buy signal in the E-minis. The next day we told the people on Twitter that we were long. And this nice rally that we just had that ended today, you could have gained anywhere from 20 to 25 points being long the E-mini. So you would have had a nice little rally there. We also just posted a little while ago that we are also long the Canadian dollar. So we had a really nice signal on that in just one day. So there's lots of great free information on there. So I invite you to follow us at SPCLST-TRADG. Okay, now as I stated, a lot of people think that, well, Steve, you traded on the floor. It's easy for you to make money because you've had the experience, and it's easy. Anyone trading on the floor with that kind of background and talent, it's just like stealing money. Well, that's not really true. When I first started trading, I probably struggled like most of you have. I couldn't seem to make ends meet. In fact, I probably traded the way everyone trades. I tried to pick tops and bottoms, so that's what we're going to be talking about today. And the trouble was I would have 3 or 4 or even 5 or 6 great winners in a row where I'd make a ton of money, and then the last trade, I'd give it all back. And so there was no consistency in my trading. I was lucky enough to come in contact with some mentors on the floor were able to change my way of thinking and my trading around. They really told me that, Steve, you're trading the way most traders trade, and it's really, you know, conventional wisdom says that this stuff will work, but really, if you look at it in the big overall picture, it really doesn't work. So what I'm going to share with you is what my mentors taught me, and it's really the specialist edge, which is going against the grain. It's going against what conventional wisdom tells us to be true, and really trading, learning how to trade in sync with the market. It's keeping things as simple and as basic as possible, not relying on outside sources to make our decisions, but relying on our own selves to make our decision, and just sound education in your trading. So that's what the specialist edge is, and my goal, once you become a member of Specialist Trading, is to teach you how to trade with the specialist edge. Now, we're going to talk about how most people trade tops and bottoms. Okay, I'm going to show you how most people, you know, get involved in trading, and this is usually the easiest and simplest way to get involved in trading. It's by picking tops and bottoms, and it's just pretty much human nature that when something is tremendously oversold, you want to buy it, and in your opinion, when it's tremendously overbought, you want to sell it, because, you know, most things can only go up so far or go down so low. Once again, this was the way I started trading when I first began my career on the floor. All right, so let's start out by looking at stocks. I'm going to show you some older examples. These are not meant to be, you know, current, only because I'm trying to really, for educational purposes, show you these examples, these ideal examples, to show you the norm. Later on in the presentation, I will show you some current charts just of the last couple of days where we'll show you exactly how to trade tops and bottoms. But this is the way most people trade tops and bottoms for stocks. Let's start with stocks and look at Apple. Okay, this is an older chart of Apple. And if you want to trade tops and bottoms, conventional wisdom says to use some type of overbought, oversold oscillator. In this case, we're looking at the slow stochastic. Okay, and that blue top line you see here is our top threshold of roughly 80, and the bottom blue line is 20. Now, once again, the conventional wisdom says that when these two lines cross, that's your key to sell, and when they cross over, that's your key to buy when you're in the overbought area, excuse me, and in the oversold area. So if we look at this right here, the two lines crossed in the oversold area, so this would have been your buy area right here, and it actually turned out very nicely. You see Apple went straight up after that. And then once these two lines crossed again, the fast and the slow stochastic, this was your trigger to sell, and you had a really nice trade there. So two great trades, the way most people trade tops and bottoms. All right, now if we go back to the well once more, we see here that the lines crossed over in oversold territory. So you jump in again to purchase, and you had a little bit of trouble right here, but ultimately it went back in your favor, so you had another nice trade. But it really didn't go up that far, and guess what? We're right back in the oversold territory again. So you jump back in, you say, you know what? I've had 2 or 3 good winning trades. I'm going to jump back in. I'm going to double down and purchase some more here. And it goes lower. And we have another crossover in the oversold, so you decide to buy some more, triple down, and it goes even lower. So this is the way most people trade tops and bottoms. This technique works until it doesn't work, and usually you give everything back that you made on the winning trades. This works in the E-mini as well. Let's say you don't trade stocks, you trade the E-mini. Well, let's look at a daily chart of the E-mini. Remember, this is an older chart, but we're looking at this for conventional, you know, educational purposes. We have the overbought, oversold oscillator here, and it doesn't really matter which one you use because all work the same, or they tell you overbought and oversold regions. And you use the same conventional type of trading. When the lines cross over in the overbought area, you should be selling, which would have worked nicely right here. You had about a nice, good 20 or 40 point move to the downside. And then once they cross above, then you buy again. So this looks very good. Again, you had a couple of good winning trades, but guess what? Now we have crossover in the overbought, so you decide to sell here. All right? You've had two good winning trades under your belt, so you want to get back in. It doesn't really go lower, but that's okay. You have some extra money to work with, some extra cash, so you decide to sell another lot, and it goes even higher and higher until you give everything back that you made on the first 2 trades. Does this look familiar? I know it does to me because, once again, this is the way I used to trade. Let's look at the Forex markets for these people that trade the currency pairs. Same concept will apply, and it applies even worse in the Forex markets because they have some of the best trends around. So if you're on the wrong side, you can really, really get hurt. Here's an example with the dollar yen. We are in the so-called overbought territory. The lines cross over, so you decide to go short. It doesn't go down, so you decide to go short some more. It doesn't go down, so you'll just try and triple down until you find out that you're hiding your statements from your spouse and you really have no more money left to trade with. Okay? This is very common, especially with the Forex markets. So there is a fundamental flaw when trading overbought, oversold. The reason is it's like the slot machines. Okay? They'll give you this false sense of security thinking that, well, I had a couple of good trades here. Just like the slot machines, I had a couple of nice wins, a couple of nice jackpots. But over time, you'll see that you really have nothing to show and that you've lost money. It's the same way with trading tops and bottoms. There is no consistency in it. And here's what my mentors taught me. They said, Steve, the one rule you should learn is that there is no such thing as overbought or oversold. We've been sold a bag of goods. There is no such thing as overbought and sold. As you just seen in the 3 examples I showed you, markets can go up as high as they want to, and they can go down as low as they want to. They can go down to zero. We've seen stocks go down to zero in bankruptcy, and investors have lost everything. So there's no such thing as overbought and oversold, and there's no reason why you should try to figure out what overbought and oversold is. Remember, it'll work for a few times to give you this false sense of security, but when it doesn't work, you usually give everything back. So what is the right way to trade tops and bottoms then? After all, this is the title of the webinar. There must be some right way to trade tops and bottoms. There is, and it's really simple. You just go with them. All right? Now, what do I mean by going with the tops and bottoms? Well, let's look back at our examples again. Remember, we picked these for educational purposes. Let's look back at Apple. Now, we originally said that when we had the overbought and oversold territories down here, those were prime areas for selling and for buying. But what we want to do now is we want to add one more indicator. That's the 50-period simple moving average. It's probably the most important tool we use at specialist trading. In fact, we call it the buy-sell line. Why do we call it that? Because if price is below that 50-period simple moving average line, then you're only going to be shorting. It doesn't matter if it's a stock. It doesn't matter if it's the E-mini futures, any other futures. It doesn't matter if it's a currency pair. And as well, it doesn't matter what time frame. I don't care if you're looking at a 5-minute chart of Apple or if you're looking at a monthly chart of the dollar-yen. It does not matter. If price is below the 50-period simple moving average, you will never look to go long, whatever the signal is. And if price is below, then you'll only be looking to go short, as we see in this example. So how are we going to go with this tops and bottoms strategy that we talk about? Well, we're going to use the same tools here, but now we want to look for the oversold, the so-called oversold areas, as we see here circled in red. You see these right here? And we want to go with these, meaning that whenever a short-term low was created in this oversold area, as you see right here, these were all short-term lows, and they were all in the oversold area, this is where we want to go short once they are exceeded or broken, as right here. You see that? This is where you'd be going short. And you see how this is much more conducive to being in sync with the stock or the future or the currency pair, as opposed to trying to go against it and pick a top or a bottom. Okay? You're not trying to fight it. You're just simply going with it. Whenever a bottom is formed in this oversold area, as we have right here, and right here, this is where you're going to be selling. Conversely, let's look at the E-mini. We're going to do the exact same thing. Here's the old chart we used to look at now, and here's where we got killed trying to sell more and more contracts. But now we're going to add the buy-sell line, or the 50-period simple moving average. Okay, you see that right there? And the first thing we ask ourselves is, where is price in relation to that 50-period simple moving average? Obviously, the majority of price is above. So if price is above, we are not even going to consider shorting anything. We won't consider it. We won't take any signal. We don't care how strong it is. We'll only look for buy signals because we want to be in sync. Remember, we want to go with the flow instead of trying to fight it. Okay? All right, so now that we know we're going to be going long, now we want to look for these overbought areas. Okay, so we're going to be looking at this area right here and this large area right here. And every time a short-term top, as you see right here, right here, right here, here, was formed, these will be our areas from which we will go long once they are exceeded or once they're broken. So as you can see, each one of these levels was broken, and each one of these you could have purchased. See how we're using these conventional tops to help us get long, not to help us get short, because 9 times out of 10, picking a top doesn't work, all right? So why don't we just go with it instead of trying to fight it? How about the example we showed you with the Forex with the dollar-yen, all right? First thing we did was try to short this, and as you can see, we really got the bag handed to us here because this is a terrible short. The dollar-yen just kept going higher and higher. Had we added our simple tool, which is the 50-period simple moving average, we would have seen that, wow, we had no business even shorting it. The only thing we should have been doing was going long. Why? Because price was above that 50-period simple moving average. Now, we're looking only at daily bars here, but trust me, this could work on a weekly bar, it could work on a 5-minute bar, it could work on a tick bar, it doesn't matter, and it doesn't matter what market we're looking at. So, we're above the 50-period, this means we're only looking to go long. Now we want to look at the so-called overbought areas, which are right here in the oscillator. This is the slow stochastic. So each time we have this overbought area here, we want to look to see where the tops were. And if these tops are exceeded, these are our areas to go long. Okay? You see how simple that is. Now right now we're just showing you an entry technique, but this is probably, half the battle here, knowing when to get in. It would be much more conducive to being consistent by going with the flow as opposed to trying to fight it and trying to say, well, the market has topped out, I'm going to sell it right here. Or the market has gone low enough, it can't go any lower. This chat room I'm in says it's bottomed out, we've got to purchase it here. Okay? Once again, that'll work maybe 9 times out of 10, but the 10th time it doesn't, that's where you'll give everything back. Now let me show you a current example because this will fly in the face of, I'm sure a lot of you will, after this presentation, go and look at some of your charts and go, well, Steve, this didn't work too well right here. So let me show you a current example in Twitter. All right. So what we've done is we have the indicator, the overbought, oversold, slow stochastic. And remember, you could use this with any oscillator. It doesn't have to be the slow stochastic. It could be anything you decide to use, any momentum oscillator. It doesn't matter. And we've added the 50-period simple moving average on Twitter. Going back roughly to the beginning of February, we've been below the 50-period simple moving average. So this means we've only wanted to short Twitter. Now, if we had waited for this, we have no bottoms that have been formed. As you see right here, this was the oversold area. There were no short-term bottoms. We had some bottoms here, but they weren't in the oversold area. And then we had another oversold area here, but we don't have a bottom formed yet. So we would have missed all of this nice movement to the downside, about 5 to 7 points. So I'm sure some people would say, Steve, you miss a lot of stuff waiting for this overbought or oversold area sometime. It's true, you can. So how can we alleviate that? How can we get into trades and not have to wait for this so-called overbought, oversold by relying on this indicator? Well, we can simply use the PET-D. This is our Primo early trend detector. This is a proprietary tool that I learned while I was on the floor. The only trouble was when I was on the floor, I had to calculate it by hand, and I couldn't use it for intraday because it was a little bit too difficult to figure out for every 5 minutes. But now with the advent of add-ons and with different ways in which to mechanize it, we can use this PET-D tool for any time frame, any direction. So what exactly is it? It's a proprietary color bar algorithm. And what it does, it's based off of momentum. So if we have a series of green bars, this is telling us that we have a strong uptrend in place. Now, this is an ideal situation here. We see all of the bars are all green. Sometimes you'll see a splattering of a couple of red here and there, but if the majority of all the bars are green, you have a strong uptrend in place. And then vice versa, if the majority of bars are red, then you have a strong short-term downtrend in place. So this has really given us a lot of insight into that so-called conventional overbought and oversold. This is telling us the sync we want to be in. This is telling us the direction of the market on the short term. So how can we apply this? Well, here's the buy pattern you want to use with this. You want to look for price to trade above an all-green pivot high. Okay? So you want to buy when price trades 1 tick or 1 pip above the pivot high. So for those of you who aren't familiar with what a pivot high is, this is what a pivot high looks like. You have a high followed by a higher high followed by a lower high. So this is kind of a short-term top here. And once price trades above that, that's where you buy. That's provided all these bars are green with the proprietary PET-D color tool. Now, what if we want to go short? Well, we just look for price to trade below an all red pivot low. All right, so we're going to go short. We're going to sell when price trades one tick or one pip below the pivot low. Now, conversely, a pivot low is just when you have three bars all here in red. You have a low followed by a lower low followed by a higher low. And you make this kind of a V type of bottom. If we exceed that to the downside, we'll simply go short once we pass that low, that short-term pivot low. That's how simple it is. So if we want to go long, we want to see a little top where all three bars are in green. If we want to go short, we want to see a bottom that's broken down where all the bars are red. And that's it. So if we look back at the Twitter model again, we see here using the tools I showed you earlier that anyone can use, but it's not as state-of-the-art as what I'm going to be sharing with you right now. But we just simply will remove the overbought, oversold oscillator. And if you want to be even more aggressive, we can remove the 50-period simple moving average because it takes this in consideration in the proprietary algorithm. All right? So now we're left with Twitter, just blank screen, and now we add the PET-D, which is the proprietary algorithm. And this is the same chart, just on a different scale. And we see here that all the bars are red. So the entire time using the PET-D, we've been in a red mode, in a shorting mode. So we don't need to worry about an overbought, oversold oscillator. We don't really need to worry about the 50-period simple moving average because it takes this into account. We can still plot it if we'd like to. But what we want to do is look for those little short-term lows, which are right here. You see the pivot lows. You see a low followed by a lower low, followed by a higher low, and so on. And these would have been all your entry points to go short. So you could have made a nice 3 or 4 points in Twitter trading with the PET-D, whereas if you used, or relied on an overbought, oversold tool or something else, you probably wouldn't have had a trade at all. So this is a very current chart up to the last couple of days. Let's look at some more examples where we use the PET-D and how it can really help us to get in these markets. Let's look at stocks again. Let's start off by looking at gold, GLD. All right, this is the ETF that mirrors gold. Now, a lot of people have been left holding the bag in gold. They've either tried to short it, which is wrong in itself because it's been above the 50-period simple moving average recently, or else they've stood on the sidelines. They don't believe it. So how could we have taken advantage of this using our PET-D? Well, here's just a standard blank chart going all the way back to the middle or the beginning of January. And we see here, once we add the PET-D, you see here the majority of bars are all green, all the way back to January. We only had about 2 or 3 bars here that were red, but remember, as long as the majority are one certain color, that's the direction you want to be going in. All right, so once that we see here that these bars are green, then we look for these short-term tops, because if we have green bars, that means the short-term direction is up. So we're only going to be going in sync with the direction of the market, and this is all the areas you could have purchased. Every time we went above a short-term high, that was your purchasing point. See how simple this is? A lot easier going and trading this way as opposed to trying to short gold, and every time it went down you felt a little bit better, but then it would make a new high in roughly about 3 to 5 more days. How about Netflix? Okay, this is a chart up until a couple of days ago. We see here this is your static, just the common chart here. Let's add the PET-D tool, and we see here that starting out mid-January, I should say, all the bars were green until about a week or 2 ago where the bars just suddenly turned to red. Okay, so how could we have applied this? Well, when the bars are green, we're only looking to go long. So we're looking for these little tops to be broken out of, all these little short-term highs. And then once we turn red, we're looking for these short-term bottoms, okay? So here's where we could have had a long, and here's where we could have had a short. Very simple. How about the E-minis? Okay, let's look at the E-minis. Here's a standard daily chart of the current contract going all the way back to roughly beginning of February. As you can see, coming into the trade, we were all red. And then the first week of February, we changed to all green. And then we had a splattering of a couple of red here, but majority are still green. So if we applied, we had the short-term lows right here. You could have sold at these spots. And it doesn't look like a lot of room that happened, but trust me, that was a good 40 points in the E-mini, or a good $2,000 per contract on this small move from roughly here down to here. And the same thing here. Once we turned all green, you could have put your short-term buy signals in once these tops were broken. And you could trade it any way. You could just go for a couple of points, you could go for 10, you could go for 20. It's all up to you, and we show you ways in the course in which to exit these trades. How about intraday trading? Okay, here's a 1,000 tick bar chart. This happened last week when the market was really selling off. Remember that one day where the market really fell out of bed? Well, we look here on a 1,000 tick bar chart of the E-mini, and obviously all the bars are red. So how could we have played this? This is a great example of just going with the flow. If someone would have tried to pick a bottom here, you would have really lost a lot of money, saying, well, here we bottomed on this kind of bounce here. Well, no, we didn't. Well, now we're bouncing and we're going to bottom right here. Well, I guess we're going to bottom right here. You see how, trying to pick tops and bottoms will really get you in trouble once you get one of these strong trends in play. So the best thing is just look for these strong trends and then to go with them. So since all the bars are red, we're looking for these little short-term bottoms we see here, and these are our signals to enter into the trade. Look at all the entries you could have had here, roughly in this hour, 2-hour time slot, and how you could have made some really nice profits just trading and going short and in sync as opposed to trying to pick a bottom. And then lastly, let's look at the Forex markets. It works just as well in the Forex markets in any time frame. Let's look at a weekly chart of the British pound. If we go all the way back to August of last year, we see that we've been in total green bars on a weekly time frame in the British pound. So this means we should only be looking to go long the British pound. People who have been trying to short this would have lost a lot of money. But we know now that we don't want to pick tops or bottoms. The right way to trade tops and bottoms is simply to go with them. So you find those tops as long as the bars are green, and you simply buy, and look what happened. We can also go down to daily bars. Here's a current chart of the Swiss franc. Up until a couple of days ago, the Swiss franc has been going lower as all the bars are red. So we just look for short-term bottoms. Each one of these bottoms we could have sold. Now I know it doesn't look like a lot. A lot of people aren't familiar with how the currency pairs work, but there's hundreds, if not thousands of dollars you could have made here just trading one or two lots. Now, important points to remember, because we're talking about picking tops and bottoms. Conventional wisdom has always told us that when something is overbought, you should sell it, and when something is oversold, you should buy it. And this is, once again, is the way 99.9% of all traders trade. I know personally because I used to trade this way. This is probably the only way I ever traded when I first started, all right? Because I was taught this is what you're supposed to be doing. Either we use some type of indicator, or we look at some type of support and resistance, or some chart pattern that tells us things are overbought or oversold, or else we even listen to some trading guru tell us something is overbought and oversold. It wasn't until my mentors really changed my way of thinking when they said, Steve, there is no such thing as overbought or oversold. You must fully understand this first if you want to be successful and you want to get on that road to consistency. Because it's really a sucker's bet to think that something is overbought or oversold. It'll eventually get back to you and bite you, you know where, and you'll give everything back. They taught me, they said, Steve, the key to success is longevity. And it's not about hitting home runs every once in a while. It's about being able to be consistent in your trading. And trying to trade overbought and oversold, tops and bottoms, there is no consistency in that. So ultimately, the lesson learned was never, ever try to pick tops and bottoms. We're never, ever going to try and pick a top and bottom. All right? I know it may be so inviting to think that something is so low, and you actually may see that it works. But over time, over the long haul, you will see every once in a while a trade that just does not work, and it is a disaster, and you'll thank yourself for not getting involved in that trade. And the last thing is always use the PET D. Why? Because the PET D is a great tool to tell you the short-term trend direction. It's a proprietary tool that is based off momentum. We don't share the rules with people because it's that important. But seriously, it's such a good tool. It's just mainly a trend filter. That's all we're trying to do is tell us which direction. And then we can devise strategies and trading techniques based off of this strong trend that the PET D realizes for us. Now, if I could just take a few seconds here, I'd like to invite all of you to become members of our PET D course, what we just shared with you right now. This is a fantastic course. In fact, we've had such great response on this that we're offering a tremendous bonus here for the people that are in attendance today, because we may change the actual type of selling process of this PET D in the future because we've had such a strong reaction to it. So we're inviting you all to become members of the PET D course, and we're offering 4 trading techniques in this course along with bonuses. And let me share with you one of the great bonuses of using the PET D, because up until now we just basically shared with you some average to intraday to daily time frames. But a lot of people would be interested in knowing how this works for the long term. So let me show you how this could work as a long-term directional tool. Let's look at a chart of the S&P index going all the way back almost 20 years, back to 1994-95, okay? And as we can see here, the index had some really nice swings, all right? And starting in 94-95, we went straight up to 2000 until the bubble burst, and the dot-com bubble burst, and we went straight down until we finally bottomed out in roughly around 2003, and then we had this really nice rally taking us all the way up to 2008, and then that was the banking and the housing crisis, and that's where the market fell out of bed again. We started firming up again in 2010, and we've been going up ever since. Now, what if you could have known in advance, or at least had some great tool that could tell you when these things were going to be changing the direction, just going with the trend, not trying to pick a top or a bottom, but just knowing once a trend had begun in a certain direction? Well, there was. All we had to do was apply the PET D. And as you can see, remember, when there is an abundance, when there is a propensity for any one color, that is the short-term direction. So you see here, using this on monthly time frame, you could have been long this entire time up until 2000, 2001, when we had anywhere from 2 to 3 to 4 bars that changed color and were in sync. So then we could have changed our direction and gotten out of the market, or if we were more aggressive, we could have gotten short until 2003, 2004, when we had 3 or 4 consistent green bars now. So that was our signal that the trend had changed. And so now we were going all the way back up to 2008. Now right here, actually at the end of 2007, beginning of 2008, we had 3 to 4 to 5 bars turn red. So this was our signal either to get out of our long-term, either our IRAs or our long-term portfolios, and either be on the sidelines in cash, or if you were aggressive, we could be going short, and you could have ridden this strong downward movement. And then once again, if you wanted to get back in the market, we had 3 to 4 consistent bars in 2010 turn green, and we've been green ever since. Sure, you're going to see every now and then 1 or 2 bars in the opposite color, but remember, we need to see 2 to 5 consistent bars of a specific color to tell us that we are in a trend. So as long as we had, starting out with those green bars, we've been long ever since 2009, 2010 in a long-term portfolio. So this is one of the best things about the PET D. It not only can be used for intraday charts, as I showed you trading the E-mini, you can also use it for your IRAs or for your long-term investments, looking at monthly bars. So once you become a member of the PET D, you're going to get a roadmap for any market, as we just explained. It's a proprietary color bar algorithm, so this includes the add-on. Okay, you can apply this add-on for TradeStation, for Metastock, for NinjaTrader, for MT4, and automatically, once you switch it on, the colors will turn either green or red. We're also going to give you 2 continuation trading techniques and 2 pullback trading techniques using the PET D. We'll also share with you a proprietary trailing stop technique. Remember that you can apply this to any time frame, any market. You'll get my personal email address, and all these bonuses are included. Now, remember I said earlier that we've had such a strong response to the PET D when we first introduced it a couple of months ago that we're really seriously considering changing this into some type of yearly licensing fee, where it will cost you anywhere from $2,000 to $3,000 to $4,000 to license it per year. So before we go in that direction, we're offering it for a discounted price down to $12.95. This is a lifetime application and the course included. Now, usually the course price is $15.95, but for the attendees today, we've discounted it down to $12.95. Once again, this is a lifetime application, so you can have this for the rest of your life. Fairly soon, we may be doing this into a yearly type of licensing where you'll have to renew the membership each and every year. Now, once again, we've reduced it from $15.95 down to $12.95, but we are making payment plans available. So you can work with any of our trading consultants. If $12.95 is a little bit too difficult for you to meet right now, they can reduce it down to a series of payments so you can pay on a monthly basis and still be able to use the PET D. But this is for a limited time only. So if you're serious about taking your trading to the next level and really being in sync with the market, and you see how simple it is to use this tool, I strongly urge you to become a member of the PET D course, and you can start using it as early as tomorrow. I use the PET D every day. I used it today. It really helped me. If you saw that really strong downward movement we had today in the E-mini, it gave me a fair warning to get out of the market, and I saw all the bars turn red, and that was my signal to get out. So it's a great, great technique. And then in the last hour, looking at a 2,000 tick bar chart, the bars quickly turned over into green and got me back in the market on the long side. So it's a great tool to use anytime you want, any time frame, in any direction, and for any market, whether you trade currency pairs, stocks, or the E-minis. Now, for more information, you can go to our sister website. That's ProTraderStrategies.com. That's where they market and sell all of our different courses and our different strategies. You can get more information about myself and our courses there. If you'd like to speak to someone, you can contact any one of our trading consultants at trading@ProTraderStrategies.com. Or if you'd like to call us directly, you can give us a call at area code 310-598-6677. Now, I thank you so much for waiting. I'm going to open up the question and answer box right now and see if we have any questions. What about trading the CL? John says, yeah, John, that's a very good question. In fact, it can trade the CL. And I'm sorry, I don't have a chart. This is a static PowerPoint presentation, but I do have a chart of the crude oil and as well as heating oil. And it works very nicely. But remember, it's good for capturing those trends. So if you want to see some nice trends with those, and it works on commodities as well. As we showed you with gold, you can use it with gold, with silver, a lot of different commodities. You can use it with bonds. We've had people using it intraday on commodities. So it's a great, great tool, and it works very nicely. I'm sorry I didn't include a chart of that, but it does work very nicely on that. Let me see here before we get too many questions. Let me see. Paul says, I got in late. Which trading platform will the indicator work on? Okay, Paul, it automatically works for TradeStation, NinjaTrader, MT4 for all you currency pair traders, and lastly, was a Metastock. Yeah, so you can apply that. Those are the four major platforms, okay? And I believe we're starting to put together possibly something for Thinkorswim, but at this point right now, you'd have to contact one of our trading consultants just to make sure. John also asked, the code of the indicators will not be open, I assume. Yes, John. At this point, it's proprietary, and all we can tell you is that it's based off momentum. It's nothing that is all that far off advanced, and it is that so private and secret. But it's just something that we want to, we knew that this was going to be extremely, extremely powerful for people to use, and we just wanted to keep it in-house to people that are serious about using this. We didn't want it to have it so that 5 minutes later it would be on YouTube and people would be showing it to all over the world how easy it is to construct this. It is simple, but it's not easy. You have to have some mathematics behind it in order to do this. And as I stated, when I was on the floor, I used to construct this. My mentors taught me this. I used to construct it, but I could only use it for daily bars. Now with the advent of add-ons and the internet, we have all these programmers now that just simply furnished us with the add-on so we can use it for any time frame in any market. And that's the beauty of it. Carlos asks, what is the smallest intraday time frame that makes sense to play a 50 simple moving average as a benchmark to go long or short? That's a good question, Carlos. I have used the 50 period simple moving average on virtually every time frame that I trade. I would say the smallest time frame I've even used is maybe a 100 tick bar chart. That's when the markets were really moving. I wouldn't suggest that, and I wouldn't recommend that, but I was looking at it at one time in 2008 when markets were moving extremely, extremely fast, and so I was trying to get some really quick trades in there. But that's just special. Those are special, sequences there. I would really say that, if you're looking at a 1 minute time frame, it works fine. If you're looking at a 5 minute time frame, if you're looking at a 1,000 tick bar chart, it works fine. I use it all the time, as I say, and the beauty of why we use this, it's not so magic that it's the number 50. The concept that we want to impress upon all of our members as students is that you want to be in sync with the overall market. And if the overall market is below its average, then that means you should only be looking to go short, because over time you will have a higher propensity for winning trades if you're looking to go short. Now, if price is above its average, or over time you will have higher probability trades if you're only looking to go long. So it really just puts you in sync with the overall trend. Now, coupled with the PET-D, which is for a short-term trend, now you have like a double whammy. So it's a really, really great tool, those two tools to combine together. Okay? I hope that answers your question. Charles asked, what about NG, which is natural gas? Yeah, it works in virtually all those markets, okay? And it really works well. I'm not going to promise you that every trade is going to be a perfect, 500% winner, but you're going to see some really nice setups. That's what we're trying to share with you. You're going to get some great setups regardless if you're looking at natural gas, if you're looking at bonds, if you're looking at the euro dollar, okay? Does your software work on Apple computers? John, yeah, I would think it does. I would pretty much believe it does, but I would have to check. Since I don't use Apple myself, and I really never have, I would contact one of our trading consultants just to make sure. But I'm pretty sure if you can get TradeStation for Apple, or if you can get one of these platforms for Apple, then it's just as easy to apply the PET-D. Okay. Let me get some more questions here as I scroll down. In trend trading, the cheaper stocks, those stocks which are under $5, which is the minimum volume required? Okay, Tom is basically asking, if you're looking to trend trade stocks that are under $5, which is the minimum volume required? Tom, first of all, remember I told you what my mentors taught me was to keep things as simple as possible, and they said one of the things we do to overcomplicate our trading is to put too much reliance on volume. So we really don't even look at volume. We really more look at where price is in relation to the 50-period simple moving average. We use the PET-D, and then we look for simple patterns, okay? If we see all of these things in conjunction, well, usually we'll get a nice signal. It'll be relative in terms of a $5 stock as opposed to a $100 stock, but we really don't have any emphasis on volume. Since I was working on the floor, I haven't looked at volume, okay? And I traded stocks. I was on the floor, as I said, for 16 years. I stopped using volume after about the first or second year. So I don't really even concern myself with volume. It's just one more thing to actually get in the way of complicating your trading. And we want to keep things as simple as possible. So the best thing is to say, wow, one less thing I have to worry about. Okay, so we don't concern ourselves with volume at all. Let me see here. Let me see another. Will you be emailing a link to this recording? Yes, Joe, we'll send you a recording. As you see here, our trading consultants answered that question for you. Bernie asks, will you need to periodically update the PET-D algo or release new versions? No, Bernie, those who buy, as you see here, will get updates and new releases for life, because that's part, you're now going to be a lifetime member. But since we've had it, and since I've been using it, we've only had one update. And when I say since I've been using it, in my 37 years, I've only had one update of it. So I don't see a lot. Once again, if you have indicators that have updates or are constantly changing, once again, you're taking away from that consistency because you're overcomplicating things and you're trying to fit the environment as opposed to just having something that works a good percentage of the time. So we will have updates from time to time in different ways in which to enhance your trading, but you're not going to see that much. Overall, its consistency has lasted since, the last 35, 37 years, okay? Let's see here. What else do we have? Keith asks, on Forex, do you use tick charts or what? Usually, Keith, on Forex, my personal way of trading is on daily bar charts. I like to look at daily bars. I seem to be better in sync when I'm looking at daily bars. Now, this is just a personal question. I know a lot of people are always asking, well, what do you trade? What's your favorite time frame? What do you think is the best time frame? And I always say the best time frame is the one you feel the most comfortable in. Because I know hundreds of traders who trade the same way I do but could never trade a daily bar, or vice versa. They could never trade a tick bar. They have to trade something that they feel comfortable in. They may feel that a tick bar is too intense, whereas I trade 1,000 tick bar chart in the E-mini. They may feel that's way too intense. So how can that be the perfect time frame? Whereas they may like an hourly time frame or perhaps a daily time frame. So the perfect time frame is what makes sense to you, because one where you will not be too intense and you will not be able to follow the trade and follow the trade plan. So what we do is we tell all of our students, once we get them in a course and they decide on which strategy they want to use, we tell them to paper trade for a while using different time frames and different ways so that they can finally pick one after a week or two and possibly a month that best suits their personality, okay? Keith asks, can you scalp with this or is it lagging? Thanks. Keith, yes, you can scalp. I don't really recommend it, but if you remember, I showed you a couple of examples there in the E-mini where it was going up and it kept going. And a lot of people I know would say, well, where do you get out? Where do you get out? One way in which to scalp is to just say, I'm going to take a fixed exit point. All right, it can be 1 point, it can be a quick point, or it can be a quick half point if you're intraday trading. Or if you're holding overnight, it can be a quick 5 or 10 points, okay, in the E-mini. It can be the same way with stocks. If you're trading a stock using the PET D, you could say, I'm going to get out at the first point, all right? Now, many times you'll reach that in the same day you enter it. Other times it may take a little longer. So I don't really recommend scalping. It's up to you, but sure, that's what I would suggest if you're going to scalp. In other words, scalping would mean in this context just using a fixed exit point each and every time. Okay. Mike asks, does this software provide entry points? Well, the software doesn't provide entry points, but what we do is we teach you that in the course, and it's very simple. In other words, this was one of the techniques that's in the course where you would have seen that the PET D made a short-term top or a short-term bottom. So you know automatically if there's a short-term top there, you're simply going to enter once it's exceeded. And it's very simple to, there's nothing that you have to have an arrow telling you that you have to buy there. Now we have courses where we do provide up and down arrows, such as strategy number 4, such as strategy number 1, things of those natures, because they're a little bit more difficult. They're built off of patterns and not so much the PET D. But once you're trading the PET D, it's extremely simple to see things because all the bars are either green or they're all red. So there's really not much of a decision you have to make. You know you're going to be entering. If they're all green, you're going to be entering long at a certain spot. If they're all red, you're going to be entering short at a certain spot. All right? So there are no actual up and down arrows, but we make it very easy for you. Remember, I said in the first 20 seconds of this presentation, we are an educational company. So our goal is to educate you. So don't worry, I'm there with you. I'm there with you. I walk down the road with you and hold your hand so that you'll know exactly where the entry points are, where the exit points are, where the stop placement is. Okay? We get a few more questions before we have to go. Lori asks, are there guarantees with this program? Lori, as you can see here, if you aren't happy with it, we will allow for a one-time exchange for any of our other products within 30 days. But, if you do a Google search on us and you see our experience and our customers are pretty much our guarantee process, because if you do any type of search and see people that have purchased our products, there's not going to be a lot of people complaining. In fact, there's hardly any. We have people that have been trading our strategies and our methods in over 50 countries around the world, from hedge fund traders to people that have been trading for a couple of days. So everyone seems to be happy because, once again, we're an educational company. We don't just give you something and say, well, good luck. We're there with you until you really understand the process. You can email me whenever you like. In some instances, I will talk to you over the phone if it's something that's very difficult. But usually we answer everything in an email, and you can email me 2 or 3 times a day if you'd like. This is a process where we keep in touch with you until you really get on that road to consistency. So I hope that answers your question, Laura. But if you, once again, our customers really speak for us and tell us how happy they are with our products and with our education. Okay. Well, it looks like we're at the end of the presentation and we have no more questions. And in closing, I want to thank you all for coming, and I really urge you that if you want to take your trading to the next level, use something that I've been using for the past 30, 35 years. That's the PET D. It's a great, great tool that really will just, more than anything else, get you in sync with the direction of the market. Remember, we talked about trading tops and bottoms. The reason why most people lose trading tops and bottoms is because they're trying to fight them. They're trying to pick a top and pick a bottom. And so work for a short period of time until it doesn't, and then you'll give everything back. If you could see my P&L statements from when I was on the floor, you would have been flabbergasted at how much money I made and how quickly I gave it all back because I was trading tops and bottoms. So I really, was very desperate in trying to get consistent, and my mentors basically said, Steve, you have to realize there's no such thing as overbought or oversold, so never try to trade that way. It's much better just to go in sync with the trend. And then when they shared with me the PET D and how it works, it was called something else at that time, but I changed the title because it's a proprietary algorithm now. We saw how simple it is to be in sync with the trend. And so once you're in sync, all the doors open up for you. You can apply so many different trading techniques. In fact, you can apply a trading technique that you're currently using, but I really feel that it'll increase the performance of that if you only take the signals that are in sync with the PET D. So you don't have to trade one of our strategies just to trade the PET D. You can continue to trade what you're trading, but once you've applied the PET D, if you see all the bars are green, you won't take one of your sell signals. You'll only take a buy signal. And conversely, if all the bars are red, let's say one of your strategies is giving you a buy signal, well, you'll fade that. You won't take that trade. So it'll get you in sync, and you can virtually trade anything you'd like with it. Remember, this is probably going to be going into some type of a licensing. So we're going to be leasing it out on a yearly basis for a couple of thousand, possibly even more. So you have to renew this. This is your last chance to pick this up for a very deep discount of $12.95, and you'll have it for a lifetime. So you can use this on any market, any time frames for as long as you'd like. So if you're really interested about taking your trading to the next level with the PET D, I urge you all to come on board and take advantage of our discount. Remember, if you want to have a payment plan, we can work with you on that, so you can pay it on a monthly basis at a level that meets your needs, okay? So contact one of our trading consultants at trading@protraderstrategies.com, or you can call us directly at 310-598-6677. In closing, I want to thank you so much for attending today. I hope you take advantage of that deep discount of the PET D before we increase the price to licensing fee. And I look forward to all of you becoming members of Specialist Trading. Thank you so much. I'll see you next time. Bye-bye.